April 13th, 2023, 6:01 a.m. Pacific Time. Silicon Valley Bank stock was halted. $209 billion in assets. The second largest bank failure in American history. Gone in 48 hours. But this was not an accident. This was a symptom. A tremor in a system built by 5 families. A system now cracking under its own weight. Because the story of modern finance is not one of free markets. It is a story of dynasties. 5 of them. The House of Medici. The House of Rothschild. The House of Morgan. The House of Rockefeller. The House of Goldman Sachs. From Renaissance Florence to the skyscrapers of Manhattan. These 5 dynasties designed every rule. They built every lever. They control the kill switch. And when their system breaks, as it always does, they are never the ones who pay. This is the story of the Dynastic Collapse Cycle. A 5-stage pattern where financial architects build a system, capture its regulators, engineer a crisis, consolidate power from the wreckage, and then abandon the husk they created. This pattern has destroyed every currency, every empire, and every superpower that embraced it. From the florin to the pound sterling. From the Spanish Empire to the British Empire. And the American-led financial system, their ultimate creation, is now deep in stage 4. History reveals the same 5 steps. The same playbook, executed across 5 centuries. Stage 1, the architecture. A dynasty innovates a new financial technology. They solve a critical problem for the state. In return, they receive a monopoly. Absolute control. The Medici with letters of credit. The Rothschilds with bond markets. Morgan with industrial trusts. A private system becomes public infrastructure. Stage 2, the capture. The dynasty's influence expands beyond finance. Into politics. Into media. Into academia. They lend their personnel to the government. They fund the think tanks. They shape the laws that govern their own competitors. The private architect becomes the public regulator. The referee is wearing their jersey. Stage 3, the engineered crisis. With control of the architecture and the rules, the dynasty manufactures a boom. Credit expands. Asset bubbles inflate. Then, they trigger the bust. They call in the loans. They raise the rates. They precipitate the panic they alone see coming. They are the arsonist in the fire department. Stage 4, the consolidation. In the chaos, the dynasty acts as the savior. They buy shattered assets for pennies. They demand extraordinary bailouts and legal immunity from the state. Their failed competitors are absorbed. Their monopoly becomes absolute. The crisis becomes a catalyst for greater control. Stage 5, the abandonment. The system is now hollowed out, burdened with unsustainable debt and public fury. The dynasty begins a silent transfer. They migrate their wealth and loyalty to a new system, a new rising power, leaving the old structure to collapse behind them. They jump ship and light the fuse on the powder keg. The Medici did it to the Florentine Republic. The Rothschilds did it to Europe's monarchies. The Morgans and Rockefellers did it to the American industrial heartland. And the evidence is irrefutable. We are now witnessing stage for consolidation in real time. To understand the trap, you must first meet the builders. Our story begins in 1397. Florence, Italy. Giovanni di Bicci de' Medici founds a bank. His innovation? The double-entry ledger and the bill of exchange. He turned confusing, risky bundles of IOUs into a standardized, tradable letter of credit. A financial technology. By 1434, his son Cosimo used the family's financial machinery to bankroll the Pope, and in return, was given a monopoly on the Church's vast European finances. The Medici weren't just bankers. They were the system. In 1450, the Medici Bank handled an estimated 90% of all papal revenues. By 1470, they operated the largest industrial enterprise in Europe, the Tuscan alum mines, a papal monopoly. Their currency, the Florentine florin, became the dollar of its day. They solved the state's problem, moving money across a fractured continent. And in return, they became the state. Fast forward 4 centuries. A new dynasty emerges from the Frankfurt ghetto. The Rothschilds. Their innovation? The sovereign bond market and an intelligence network that couriered information faster than any government. In 1815, Nathan Rothschild in London used his pigeon network to learn of Napoleon's defeat at Waterloo a full day before the British government. The official story says he bought British bonds, making a fortune. The truth is more profound. He didn't just bet on a sure thing. He demonstrated his system was faster than the states. It was a display of power. From 1815 to 1914, the House of Rothschild became the de facto central bank for Europe's empires. They financed the British government's purchase of the Suez Canal shares in 1875 with a £4 million loan delivered in 24 hours. They underwrote the railway boom that industrialized continents. By the late 1800s, a Rothschild sat on the board of virtually every major central bank in Europe. They solved the state's problem, funding industrial expansion and imperial wars. And in return, they dictated the terms of peace and profit. Then, the action crossed the Atlantic. The American Civil War created an ocean of debt. And from that chaos arose two dynasties that would fuse finance with industry itself. John Pierpont Morgan and John D. Rockefeller. Morgan's innovation was the trust. He didn't just loan money to companies. He restructured entire industries, eliminating competition, creating monopolies, and issuing the stocks and bonds that represented them. In 1895, with the U.S. Treasury's gold reserves nearly depleted, President Grover Cleveland didn't go to Congress. He went to J.P. Morgan. Morgan organized a private syndicate to float $65 million in gold bonds to bail out the United States government. A private citizen had become the lender of last resort. Rockefeller's innovation was vertical monopoly. He didn't just own oil wells. He owned the railroads that shipped the oil, the barrels it was stored in, and the pipelines that made railroads obsolete. By 1880, Standard Oil controlled 90% of America's refining capacity. By 1901, J.P. Morgan had created U.S. Steel, the world's first billion-dollar corporation, by consolidating 223 separate companies. The Morgan-Rockefeller alliance, through banks like Chase and Citibank, came to hold a dominant share of all corporate and government financing. They solved the state's problem, building a continental industrial superpower. And in return, they demanded, and received, immunity from its laws. The fifth dynasty emerged from this very alliance. Goldman Sachs. Founded in 1869, their rise was slower, more deliberate. Their innovation was the public offering and, later, the complex financial derivative. They perfected the art of selling ownership in companies, and then betting on their failure. In 1929, they created the Goldman Sachs Trading Corporation, a highly leveraged investment trust they sold enthusiastically to the public. They knew it was overvalued. When it collapsed, it helped trigger the Great Depression. But Goldman survived. They had mastered a new role, not just as architect or lender, but as the indispensable middleman in the securitization of everything. By the 1980s, a Goldman Sachs alumnus was in every presidential administration. By the 2008 crisis, their former employees sat at the helm of the U.S. Treasury, the New York Federal Reserve, and the key banks on the other side of their trades. They solved the state's new problem, funding growth through complex, globalized capital markets. And in return, they wrote the rulebook for global finance. 5 dynasties. 1 repeating first move, provide an indispensable solution, and then demand the keys to the kingdom. The pattern breakdown. This is where the history books stop. With the rise. With the power. But the Dynasties playbook is only just beginning. The next moves are where empires are bled dry. Stage 1. The architecture. This is the founding moment. The dynasty builds the plumbing of a new economy. Medici example, 1397 to 1460, for they didn't invent banking. They systemized it. Their Libro Segreto, secret book, and branch network created the first truly multinational corporation. The florin became the reserve currency because their trade network demanded it. They were the payment system. Rothschild example, 1800 to 1818 after Waterloo. They didn't retreat. They institutionalized. They established brothers in London, Paris, Frankfurt, Vienna, and Naples. This created the first internal capital market, allowing them to float loans across borders, bypassing kings and parliaments. They were the bond market. Morgan example, 1895 to 1907. After bailing out the U.S. Treasury, Morgan's authority was unquestioned. In the panic of 1907, as banks failed, it was J.P. Morgan who locked the leading bankers in his library and forced them to pony up a $25 million pool to save the system. The public cried out for a central bank. The Federal Reserve, created in 1913, was essentially a formalization of Morgan's private role. He was the central bank. The pattern is absolute. The dynasty's private innovation becomes public infrastructure. The state becomes a client. Dependency is cemented. Stage 2, the capture. With the architecture in place, the dynasty invades the institutions meant to oversee it. Medici example, 1434 to 1494. Cosimo de' Medici, the banker, became pater patriae, father of the nation. He controlled Florence not just with money, but with political patronage, cultural sponsorship, Brunelleschi, Donatello, and even the church. The line between the Medici Bank and the Florentine state vanished. Rothschild example, 1818 to 1914. Lionel Rothschild became the first Jewish member of the British Parliament in 1858, after an 11-year fight over swearing a Christian oath. The family financed both sides of conflicts, advised emperors, and their couriers often had diplomatic immunity. They weren't just outside governments. They were a parallel, super-governmental network. Rockefeller/Morgan example, 1900 to 1933. The Money Trust investigation in 1912 found that a small group of men led by J.P. Morgan and the Rockefeller-affiliated banks held 341 directorships in 112 corporations worth over $22 billion. They controlled credit for the entire nation. After the 1929 crash, President Hoover's Secretary of the Treasury was Andrew Mellon, one of the richest bankers in America. The fox wasn't guarding the henhouse. He had designed it. Capture is not a bribe. It is a migration of personnel and ideology. The regulatory state becomes a subsidiary. Stage 3, the engineered crisis. This is the most controversial stage, the most denied. But the pattern is etched in the data. With control of credit and regulation, the dynasty fuels a speculative mania. Then, they pull the plug. Medici example, 1470s. Under Lorenzo the Magnificent, the Medici Bank began making riskier loans to princes and kings for prestige, loans they knew could not be repaid. They also drained the bank's capital for lavish political and artistic projects. By the 1490s, the bank was insolvent. When the French invaded Italy in 1494, it triggered a run. The Medici were expelled from Florence. Their bank collapsed. But Lorenzo's family retained their vast land holdings and art wealth. They lost the bank, but saved the dynasty. Rothschild example, 1870 to 1873. The family helped finance the global railway boom, underwriting bonds for projects from the United States to Austria-Hungary. This created a massive credit bubble. In 1873, the Vienna Stock Exchange crashed, triggering the Long Depression. The Rothschilds, who had quietly begun selling and calling in loans months earlier, were positioned with liquidity. They bought devastated assets across continents for a fraction of their value. Morgan/Goldman example, 1927 to 1929. Through the creation of leveraged investment trusts, like the Goldman Sachs Trading Corp. And easy margin loans, the dynasties fueled the roaring 20s bubble. Insider accounts show partners at these firms knew the valuations were detached from reality. In the spring of 1929, key insiders, including the Rockefellers and Morgan partners, began quietly exiting the market. The crash ruined millions, but consolidated the surviving bank's power, leading directly to the formation of the modern Federal Reserve's powers in 1933 to 1935. The crisis is never an accident. It is a controlled demolition. The architecture they built is weaponized. Stage 4, the consolidation. The smoke clears. The public is terrified, bankrupt. The state is paralyzed. This is the dynasty's moment of maximum opportunity. They step forward as the responsible adults, the saviors, the only ones who can fix the system they broke. Their price? More. Medici example, 1512 to 1537. After being exiled for 18 years, the Medici returned to Florence not just as bankers, but as its hereditary dukes. The Republic was dead. Their consolidation was political absolutism. They used their surviving European network and papal alliances to cement military power. The bank was gone, but their control over the state was now total and formalized. Rothschild example, 1873 to 1890. In the wreckage of the Long Depression, the Rothschilds executed a breathtaking consolidation of global resources. They financed Cecil Rhodes's De Beers diamond monopoly in South Africa, 1888. They bankrolled the vast Rio Tinto copper mines in Spain. They loaned France the 5 billion francs to pay its war indemnity to Germany in 1871, tying a nation's survival to their bonds. Their power shifted from sovereign bonds to owning the physical resources of empire. Morgan/Rockefeller example, 1933 to 1956. The Great Depression and World War II were the ultimate consolidation events. The 1933 Banking Act, Glass-Steagall, actually protected their core commercial banking from risk, while their investment arms adapted. The Reconstruction Finance Corporation, a government bailout fund, channeled capital through their banks. World War II industrial production was orchestrated by dollar-a-year men from these same dynastic firms. They managed the state's spending, profiting from every tank, plane, and bullet. By 1955, a Senate report found that just 12 interlocking financial institutions, led by Morgan Stanley and Rockefeller's Chase Bank, controlled over 40% of all industrial assets in America. Consolidation is not about recovering losses. It is about converting crisis chaos into permanent, structural advantage. The competition is erased. The state becomes a junior partner. Stage 5, the abandonment. The final stage, the silent exit. The system they now completely control is a hollowed-out shell. It is burdened with unsustainable debt, social resentment, and diminishing returns. Its purpose, to enrich the dynasty, has been served. So, they begin a silent transfer of allegiance and capital to the next rising system. They jump ship, and often, they give the old ship a shove as they leave. Medici example, 1537 to 1743. After consolidating the Duchy of Tuscany, the Medici slowly bled it dry. By the 1600s, they were more focused on marrying into European royalty, producing 2 queens of France, than managing Florence. They became absentee landlords. When the last Medici Grand Duke, John Gaston, died in 1737 without an heir, Tuscany was a bankrupt cultural backwater. It was quietly handed over to the Austrian Habsburgs. The dynasty had abandoned its creation for royal titles elsewhere. Rothschild example, 1914 to 1945. The Rothschild system was the 19th century gold standard, imperial bond market. World War I destroyed it. The family saw it coming. In the decades prior, they had diversified into industrial holdings, mining, oil, wine, and shifted significant capital to the United States and its rising institutions. Their London and Paris houses funded the Allied war effort, but the center of financial gravity was already moving across the Atlantic. They facilitated the transfer of global financial hegemony from London to New York, a city where their influence, through partners like Kuhn Loeb, was already entrenched. Morgan/industrialist example, 1968 to 1990. The American industrial system they built peaked post-World War II. By the late 1960s, profits were stagnating. The response? Financialization. Morgan Stanley invents the hostile takeover and junk bond in the 1970s, 80s, dismantling the very industrial corporations their ancestors built. Rockefeller's Chase Bank fuels the petrodollar recycling of the 1970s, shifting focus from domestic industry to global energy finance. They profit from the deconstruction of their old system, loaning money for leveraged buyouts that left companies laden with debt and communities shattered. Their wealth became untethered from any single nation's industry. Abandonment is not a defeat. It is a strategic retreat to a new frontier funded by the carcass of the old. The dynasty survives. The system it built for the public does not. Chapter 4. We are here now. And the American-led global financial system, the ultimate creation of the Morgan, Rockefeller, and Goldman dynasty, is at stage 4. Right now, consolidation. The 2008 financial crisis was not the collapse. It was stage 3, the engineered crisis. They designed the mortgage-backed securities, the credit default swaps, the leverage. They rated them AAA. Then, they bet against them. And when it blew up, they knew the call would come. And it did. The catalyst, September 15, 2008. Lehman Brothers falls. But AIG is saved. The Troubled Asset Relief Program, TARP, is launched. $700 billion. But not for the public. For the system. This savior's arrived. The same alumni from Goldman Sachs, JP Morgan Chase, and the Rockefeller-founded Citigroup took control of the Treasury, the Federal Reserve of New York, and the bailout process. Current evidence of consolidation. Market share. Since 2008, the largest 5 banks in the U.S., JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, have seen their share of total U.S. banking assets soar from 35% to nearly 50%. The crisis destroyed their regional competitors. The Fed's balance sheet. In 2008, it was $900 billion. By 2022, it peaked at $9 trillion. This unprecedented liquidity didn't go to Main Street. It flowed through primary dealers, the same dynasty banks, propping up asset prices they owned. Regulatory capture, perfected. The 2010 Dodd-Frank Act, meant to regulate Wall Street, was written by Wall Street. Its complexity cemented the advantage of the giants who could afford compliance armies. Smaller banks were crushed by costs. The too big to fail guarantee. It is now explicit. Credit rating agencies formally incorporate government bailout expectations into the ratings of the largest banks, giving them a cheaper cost of funds, a permanent taxpayer subsidy. The COVID-19 response. 2020, the ultimate consolidation tool. The Federal Reserve's lending facilities bought corporate bonds. Who were the main sellers? The largest banks and their asset management arms. They offloaded risk directly onto the public balance sheet. The S&P 500 rose 112% from March 2020 to December 2021, while Main Street businesses died. Wealth transfer accelerated. They are the arsonist. They are the fire department. And they are also the company that sells the rebuilding supplies and owns the new, stricter building codes. Stage 4 indicators in your face right now. Indicator 1, private credit takeover. As banks retrench from risky loans after 2008, a shadow system has grown. Private credit funds, many helmed by former dynasty bankers at firms like Apollo, Leon Black, Blackstone, Stephen Schwarzman, and Goldman Sachs's asset management arm, now hold over $1.7 trillion in assets. They lend to companies at high rates with zero public transparency. This is the reprivatization of the credit system after using public bailouts to survive. Indicator 2, the Fed as permanent market maker. The Federal Reserve is no longer a last resort lender. It is a permanent participant. Its interventions in 2008, 2020, and 2023, SVB bailout, have created an unshakable market belief. The dynasty's core assets will always be backstopped. This is the Fed put. It socializes risk and privatizes gain. Indicator 3, the death of regional banks. The 2023 SVB signature, First Republic crisis, was a controlled demolition. These banks failed due to interest rate risk the giants were insulated from. Their carcasses were sold for pennies on the dollar to JP Morgan Chase. Consolidation in real time, broadcast on live TV. Indicator 4, personnel is policy. Janet Yellen, former Fed chair, ex-CEA, Treasury Secretary. Former Goldman Sachs partners leading the New York Fed, the ECB, the Bank of England. The migration of personnel between the dynasty and its regulators is a revolving door spinning at light speed. Indicator 5, the weaponization of finance. The freezing of Russian central bank assets in 2022 sent a shockwave through every other nation on Earth. The message, the dollar-based payment system, SWIFT, chips, is not neutral infrastructure. It is a geopolitical weapon controlled by a single state and the dynasties embedded within it. This accelerates Stage 5, the search for an alternative. We are living through the textbook playbook of stage for consolidation. The crisis is being managed to strengthen the architects. Chapter 5. Consequences and Timeline. So what does this mean? Where does it end? For the winners, the dynasty banks and their private equity/credit offspring will continue to absorb real assets, infrastructure, housing, energy, data. They become the landlords of the new economy. Politically connected asset managers will be the conduit for any future helicopter money or central bank digital currency (CBDC) systems. Geographic winners will be global financial hubs, New York, London, Singapore, Dubai, and jurisdictions that protect private, mobile capital. The dynasty's wealth is stateless. For the losers, the traditional middle-class saver, dependent on dollar-denominated pensions and bonds, faces financial repression, interest rates below real inflation, forever. Small and medium businesses will find credit scarcer and more expensive, crushed by monopoly power and private debt. The United States government, as the issuer of the global reserve currency, will be the last to realize it has been abandoned. It will be left holding the bag of unpayable debt, social unrest, and a hollowed-out industrial base. Projected timeline, based on historical pattern speed. The shift from consolidation, Stage 4, to abandonment, Stage 5, takes a generation, 20 to 40 years. 2025 to 2035, the managed decline continued consolidation. More frequent, contained financial spasms, like 2023, used to further centralize power. The rise of CBDCs will be framed as a solution for the public, but its architecture will be built and controlled by the dynasty's tech finance partners. Social tensions rise as inequality becomes systemic and obvious. 2035 to 2050, the pivot point, a major geopolitical or climate shock, will serve as the catalyst for the final abandonment. The dynasty's capital will have already been shifting into the infrastructure and debt of the next rising system, likely a digital/commodity-backed framework spanning parts of Asia and the Middle East. The US dollar will lose its exclusive reserve status, becoming one of several currencies in a basket. The exorbitant privilege ends. 2050 plus, the new architecture, the descendants of today's dynasties will appear as partners in new, decentralized, or multipolar financial systems. They will have shed their old branding. They will have no loyalty to the nations their ancestors once seemed to embody. Their power will remain embedded in the new code, the new networks, the new resources. The bottom line, the pattern is clear. It is not a conspiracy. It is a cycle, a logic of power. The 5 dynasties did not set out to destroy the Florentine Republic, the British Empire, or the American industrial era. They simply used them. And when they were used up, they moved on. The question is not if the current dollar-based system will be abandoned by its architects. The history of these 5 families screams that it will. The only question is when. And the clock started ticking in 2008.